Direct lending is a form of corporate debt financing in which lenders, other than banks, such as specialized alternative investment funds, provide medium long-term loans to companies. Only in the last few years, a complete and clear regulatory framework for direct lending has been reached throughout Europe. First of all, a new regulation applicable across all EU member states since December 2015 introduced the European Long-Term Investment Funds, LTIF. If we look at some of the EU member states, Germany has introduced a framework for direct lending funds in March 2016. France has issued a decree in November 2016 allowing securitization vehicles and some alternative investment funds to originate loans. In February 2016, the Law Decree number 18/2016 has expressively regulated direct lending in Italy, and in January 2017, a regulation from Bank of Italy has eliminated some legal uncertainties. Some other EU jurisdictions, such as Luxembourg, Ireland, and Netherlands, also allow direct lending through funds. There is no regulatory restrictions to direct lending in Spain, UK, and in Poland. The development of the European direct lending market traces its root back to the financial crisis, which began in 2008. As a result of the crisis, the European banking sector experienced fundamental and long-standing changes, including bankruptcy, consolidation, and nationalization in local markets, as well as foreign banks leaving some abroad markets. The dynamics regarding banks and alternative lenders are still relevant and observable in the European markets today. Banks are still experiencing significant regulatory and scrutiny and are finding it more and more difficult to finance small and medium-sized companies. Banks' balance sheet allocation to credit continue to shrink. Regulation, Basel III capital adequacy rule, and in prospective Basel IV is also having an increasing impact. Banks will need to raise more capital and will likely have to take some unconventional measure to comply. On the other hand, SMEs continue on increasing bank loans requests as well as the amount. The capital structures of SMEs are also largely reliant on short-term bank credit lines. These factors, which are mainly structural changes, have been leading to the emergence of direct lending as an established asset class also in Europe. In the US, only 25% of loans to the private sector are bank debt, versus 55% in the euro area and 80% in Italy and Spain. In the past 5 years, direct lending market has evolved from few unitranche funds trying to plug a gap in 2009 and 10, created by banks' retreat from the market after the financial crisis, to an actual market with around 66 European direct lenders, according to Deloitte. According to a study by private capital markets platform PitchBook, $52.6 billion was raised in direct lending funds in 2017, the highest ever amount recorded. Direct lending by asset manager to European companies has reached a record 20 billion euros in 2018. That compares with about 16 billion euros last year and only 5 billion euros in 2013. Yet, this is still the tip of the iceberg. Most of these funds operate in the so-called mid-market segment with significant investment size from 10 million euros to over 100 million and enterprise value of the target companies over 50 million. Alternative direct lending to SMEs, which nevertheless represent the engine of the European economy, 99.8% of enterprises in Europe are SMEs. They generate 56.8% of value added and 66.4% of employment, is still in its relative infancy. Investors with long-term commitments can be attracted by recurring income, quarterly, semi-annual proceeds, less volatility compared to other asset classes, less correlation to monetary policies, greater margins recognized as a premium for illiquidity, diversification in terms of sector and geographical position. We expect alternative direct lending to SMEs to significantly grow in the next years. If we look at other unsecured medium long term financing solutions to SMEs, most of the financing relies upon the banking system, with the average amount between 50,000 euro to 200,000. The average duration for this type of financing is equal to 3 years, up to 5 years maturity, and fully amortizing repayment structure. The mini bond market is for medium company more than small enterprises. If we look at listed mini bond in Italy with a maturity over 3 years, over 80% have a notional amount over 2 million, most of the time issued by medium-sized companies with a turnover over 10 million euros and over 50 employees, or large firms. Subordinated financing or equity-alike instruments are much more common in UK and in Central Europe compared to South of Europe, where most of the SMEs are family-owned. The structure are more common in so-called mid-market transactions sponsored by private equity funds. Senior direct lending to SMEs could report in the coming quarters the most significant growth given a clear legal framework in all Europe, a quicker and easier issuance process compared to a financial instrument like a mini bond, no paying agent, no ISIN code, no clearing needed, or a bank loan. A more tailor-made finance package, flexible maturity up to 7 years, and reimbursement structure. And finally, a public guarantee available, such as bank loans.